Hi, my name is Pat O'Connor, and today I'm talking about the Truth in Lending Act / Real Estate Settlement Procedure Act Integrated Disclosure Rule, also called TRID. Before I get started, just a few things. I'm taking the material from the study guide that I have published on Amazon up here. And if you prefer written material to audio, then that is available in both Kindle and paperback formats. Also, if you watch until the end of the video, there is a link that will be up here for you to download practice questions and answers. The link is case sensitive, so have a pen and paper and copy it down. The subscribe button is in the lower right-hand corner of the video. If you like it, if you don't want to miss anything, please take a moment to subscribe. It'll help me and it'll help you to stay informed of changes, maybe extra practice questions that I may have available to subscribers. All right, so let's get started. TRID was enacted in 2015, and it removed the TILA disclosure for most closed-end loans. Before 2015, everyone had to sign, the borrowers had to sign like a 3-sentence document that said, this is your annual percentage rate. And that was called the TILA disclosure because it was under the Truth in Lending Act. So TRID now includes those and what formerly was the good faith estimate and is now called the loan estimate for pretty much all the loans that you'll be involved in except reverse mortgages. So TRID doesn't apply to reverse mortgages, but it does apply to purchase loans, refinance loans, construction loans, vacant land, and land greater than 25 acres or more. All right, but not reverse mortgage. Reverse mortgage is still going to use the good faith estimate and the HUD-1 settlement statement. Okay. The HUD-1 settlement statement now has the APR disclosure rolled into it, and it's called the closing disclosure. So the bulk of this video covers loan estimate and closing disclosure because that's going to apply to most of the loans that you will be involved in as a loan originator. All right. So TRID went into effect in 2015, and the triggers are that when you receive a loan application, you, meaning you've passed the exam and you are now a mortgage loan originator. Once you receive the application or within 3 business days of receiving it, you need to get send the loan estimate out to them. So what are the triggers? What triggers a loan application? What's an application? 6 items. They fill those in, and that's going to trigger the disclosure of closing costs. Okay, so the items are the applicant's name, their income, their social security number, because you have to pull the credit on them, property address, estimate of value, what are they going to offer for the property, and requested loan amount. How much of a loan do you want? Okay, so facts about the loan estimate. Again, it's disclosure of the closing costs. Now, sometimes if you, like for example, you're looking at model homes in, a new subdivision that's going up, and the real estate agent that is there will say, hey, why don't you sit down here with our mortgage person? And you don't know if you're going to apply or not, but that mortgage man may go over what some of the closing costs are and just generally, and may just give you a sheet of paper that's not an official loan estimate, but give you a sheet of paper that talks about closing costs. Somewhere in there, it will say these are subject to change. All right, because it's not a formal loan estimate. It's just to give you a heads up. Okay. There's an expiration date on any loan locks, the interest rate locks. So they're not going to last indefinitely. Here, when we have, it seems like really rapidly escalating mortgage rates, I expect that locks are more important than ever. We're April 2022 and fixed rates now 5% or more. Credit report fee is the only fee that you can collect before they get the loan estimate and have given their consent to move forward. You can't take a post-dated check for an appraisal. You can't do anything like that. You can take a credit card number, but only to be used to pull the credit report. Okay, can't use it for anything else unless they are going to go forward. They can't be required to give you any documentation at all. Required. They may bring it to their first meeting with you and you have it in the file, that's fine. But their first meeting with you might just be a general discussion. So until they get this loan estimate, you can't ask them for their, income stub, pay stub, any of that kind of stuff. The loan estimate has to be mailed or delivered within 3 business days after receiving the application. Again, the application is, you got the application there and you have those 6 items filled out. And that constitutes the trigger for this loan estimate. The loan estimate has to be delivered or mailed no later than 7 days before loan consumption. So it has to be mailed or delivered within 3 business days after receiving the application, and it has to be mailed or delivered 7 days before the consumption. Now, the rules lingo says loan consumption. So loan consumption may vary between states. It could mean, according to your state, the date that you sign the contracts. I'm in Florida. When we sign the contract, generally the loan is funded immediately afterwards. In some states, there is a delay for the loan funding to give the lenders time to review the documents after everything is signed. So the state definition of loan consumption is when the borrower is now committed to the creditor. All right, so they always say, they don't say closing date in the rules. They say loan consumption date or just loan consumption. And so that's what it means. And by the way, I am following the published NMLS content guide that they have on their website. So as I go through this, as I go through the whole series of videos, it's their outline that I'm following here. So if you want to know what's next, you can look at the outline. And the link is in the description below the video. Okay, so what if they have to revise it? They can't revise an estimate because they screwed up. For a revision, because of technical issues, incorrect calculations, or low estimates, they can't just call it a revision. They can revise it if they didn't lock the interest rate in and the interest rate has now gone up. Something affects the value of the property. Some areas are subject to flooding, some are hurricanes, some may be in tornado alley. You never know what kind of thing. Or maybe there was a fire in the house. Okay? So if there's anything like that has damaged the property, you can revise the loan estimate. Maybe the borrower was fired. Lenders may check at the last minute. They may check when the application first goes in. Hey, is this person employed with you? And they may check again right before or very close to the closing. Is this person still employed? Because the borrower may not necessarily report that stuff, right? If they don't tell the loan originator, lender's not going to know. So say that they got fired or, something happened where they have less income, right? We're now just getting through the pandemic where people's hours were cut. And so if something like that happened and now you're working 20 hours instead of 40 hours, that will affect your ability to pay the mortgage. Okay. If you wait more than 10 business days to say, after you get the loan estimate, to say, okay, I'm ready to move forward. All right, at that point, then they can revise the loan estimate. If settlement is delayed for more than 60 calendar days, if you are getting a construction loan, and your original loan estimate says that you can revise it because of the delay time. Okay, so lenders have to operate within the following time frames. When reissuing an estimate, it has to be delivered or mailed within 3 business days after becoming aware of these new conditions. Not one of their technical stuff, but hey, you got fired. Okay, but your spouse is working. So, but we have to look at your income now. That may affect the loan product. It may affect interest rate. Delivery has to precede the closing disclosure that we're going to talk about. So maybe you had a last minute change and the final settlement statement's already been sent out. Okay, this loan estimate has to come before the final closing disclosure. You have to have it so that the revised estimate's received at least 4 business days before loan conception, and it has to be mailed out 7 business days. So I am assuming now there can be a long delay with regular postal mail. So I'm assuming most of the lenders are doing this by express mail or a courier. Okay. Special information booklet. This explains the settlement cost, because if you're looking at some of these documents, there's a lot of fees involved, and it's like, well, what is title insurance? What is, what's an appraisal? What's a land survey? Different kinds of, what's a loan origination fee? So it'll explain the fees, and it has to be mailed or delivered within 3 business days after receiving the application. All right, so that's with the loan estimate. So now we're talking about the closing disclosure. The borrower has to receive the closing disclosure at least 3 business days before the consummation of the loan. If the few of these items change, then it has to be redisclosed and the clock starts again. You have to wait an additional 3 business days. So if the APR, annual percentage rates, for some reason, either the interest rates, APR equals interest rate plus other financing costs. So either the interest rate has changed or you have additional higher fees. And so the APR has changed. The loan product has changed. Maybe the borrower changes their mind and interest rates are going up and they had an adjustable rate mortgage, an ARM. And now they said, oh my God, I don't want this ARM because it looks like a year from now, maybe we're going to be at 8% interest rate. Let's go to a fixed rate now. I'll feel much more comfortable. Okay, so that changes the loan product. And so that's going to require a new closing disclosure. Addition of a prepayment penalty. If for some reason or another the lender says, okay, if you pay this loan, maybe you change the product. And some products may not allow, under certain circumstances, a prepaid penalty, and now you change the product, and there's a prepaid penalty tacked on to this. So if there's other changes that aren't like these major things, like the fees, the buyer, the borrower can request that they get them 1 day before loan consummation. So what are some of these changes? Well, when the borrower receives their closing disclosure, you as a loan originator, tell them to send it to the realtor. Make sure that they're in touch with the realtor, because the first thing the realtor is going to check is a commission. Is a commission on this closing disclosure, and is it correct? Maybe it's not. Maybe there are seller credits to the buyer. Maybe the home inspection showed that some of the window sills were rotting and the seller credited the buyer $300 to replace the wood. That needs to be on the closing disclosure. And so sometimes these kind of things can get missed. So make sure the real estate agent gets a copy, because the buyer's going to be tense and may not look at things that closely. Okay. Seller hardship, you may be able to close before they've had the 3 business days if you're facing foreclosure or something along those lines. Hey, the auction's in 2 days. We need to disclose. We need to close now. And then that can be an exception. You'll put it in writing, send it to the lender, and things will get approved. The seller doesn't have this 3 business day right to review. They have 1 business day before the loan consummation to look at the closing disclosure. Sometimes they can request it, and title company will say sure, and they'll send a copy over to them. Okay, so one thing now, we have talked about the loan estimate that comes right after they receive an application, and the closing disclosure that'll come 3 business days before the closing. A lot of times the title company, if they're doing the closing, has to wait to get the final numbers from the lender. This is when we get to the math section of the tutorial. There are things like prepaid mortgage interest, and that's going to change if data closing changes, but we'll talk about that in the math section. Okay, so the loan estimate and the closing disclosure have what are called acceptable variances. They have to be identical for some categories, the numbers, the figures that are put down for certain items. They have to be identical. They can vary by 10% for some other items, or there's no limit to how much they can vary between the two. So the ones that have to be identical are the things that the lender definitely chooses. It's real estate taxes. They got to know what the real estate taxes are for whatever state, county they're working in. They have to know the lender fees. Okay, loan origination fees, interest rate. They're saying this is what we charge. Credit report. You're not saying, well, this is what I'll pay for a credit report. They're telling you this is what a credit report costs. And appraisal. Okay, so all of those things, zero variance between what's in the loan estimate and the closing disclosure. Has to be the same. Now, I know I was a mortgage broker in Florida for 7 years, starting in 2003. And I know one of the brokers that I worked for, and I was just starting, and I didn't know really beans about what was right or what was not, would switch the APR at the closing table. That was before these rules were in effect. They can't do that anymore. And so the buyer's protected. You can't do these last minute change. Oh, instead of a 1% origination fee, it's going to be a 2% origination fee. It would come out of the blue at the closing table. And I know because an investor told me that it happened to him in the past. I wasn't present when it happened, and I heard it through hearsay. But if that broker did it, I'm assuming it was pretty widespread. Okay, so 0% for things that the lender chooses and has to be right, like real estate taxes. 10% for things that they choose or they recommend. So government recording fees, they're going to put that down. There's going to be taxes to record the deed. There's going to be taxes to record the mortgage. All right. If they recommend a particular insurance company, title insurance company, sometimes you're going to have mortgage companies that are also affiliated with real estate companies and title companies. You'll have one mothership with 3 businesses under the same umbrella. Okay? So if you use a title company that your loan originator has recommended, then the charge has to be the same. Okay, there cannot be a variance between the loan estimate and the closing disclosure. What can vary without any limit is what the borrower themselves chooses. Because the loan originator is filling out this form, and how do they know? So it's your hazard insurance, right? Your home insurance policy. If you pick your own title company, charges can vary from title company to title company. Mortgage interest. Again, I talked about that before. That's going to be determined by the day of the closing. Okay, how many days interest do you have to pay for your first pay period. And we'll go into all of that in the math section. Lenders have 60 days to refund any excessive variance between the loan estimate and the closing disclosure numbers. Okay, so that's it for the loan estimate and the closing disclosure discussions. Now there's three other things here on the NMLS outline. So the first of these is the right of rescission. It applies to home improvement loans, refinances, and second mortgage loans on a primary residence. And what it does, it gives the borrower 3 days to think about these arbitrary kind of loans. Do I really need this home improvement loan? Do I need this HELOC, home equity line of credit loan? Let me think about it. Is it really the right time to refinance? So the loan won't be funded for 3 business days after all the paperwork is signed. The borrowers, when they sign the paperwork, are going to receive a notice of the right to rescind. And this tells them they have 3 business days until midnight of the 3rd day to notify the lender in writing that they're not going to move forward. And that's called the right of rescission. And so that's that. An annual escrow statement. Usually the lender arranges with a separate company called loan servicing companies to keep the escrow account, to keep track of the monthly mortgage payments, and to manage the foreclosure process if it comes to that. So those are loan services. So whoever is servicing the loan, and if the money is in escrow, they have to do an annual review of it. They have to notify the borrower, and if there is a $50 or more excess in the account, they have to refund it. They can't roll it over to the next year. All right, the last thing is documentation retention. Loan originators, mortgage broker companies have to keep a copy of the loan estimate and the closing disclosure for 3 years. Lenders have to keep the loan estimate for 3 years and the closing disclosure for 5 years. Not 10 years, 5 years. Okay, so that is the end here of the TRID discussion. You can see the link to the practice exam up here, and that will be immediately followed by 2 links to 2 other videos in this tutorial series. The next video will be on the remaining federal laws that we've not yet covered. So there's 3 or 4 of them. So these videos are uploaded every Wednesday. So please subscribe if you don't want to miss them. And I will see you next week. Bye.